Well, it's hump day, so happy Wednesday, everyone, and a very special welcome to all of the new options traders in this group. We've had quite a few this week, and these markets are interesting to say the least because we've had a nice bull run here, but we've also got the volatility, and it's created a nice situation for those who have been doing diagonal spreads. And I'm getting a lot of emails and questions and coaching questions about diagonal spreads. And they're a wonderful strategy, but there's a couple of things that you have to be aware of. And so I wanted to pass on two invaluable tips for diagonal spreads. So as a quick review, remember that a diagonal spread is like most spreads in that it's going to involve a long and a short option. But we're going to have different expirations and different strikes. So let's say that you buy a 3-month $100 call and you sell maybe weekly 105 calls against it. So in a sense, it's like a covered call, but instead of buying the stock, you're buying this longer dated call as a proxy for the stock, and then you're trying to sell these weekly options against it. So the names of these spreads, at least most of them, come from your broker's platform. So let's say we've got our expiration dates across the top, we have our strikes down the vertical, and let's say you buy a January 50 call and sell a Jan 55. Notice that you are operating in the vertical column, and that is a vertical spread. On the other hand, perhaps you buy a March 55 call and you sell a Feb 55 call against it. You're operating in the horizontal row right here. It's the same strike, but different expirations. That's what you're spreading. This is a horizontal spread, more commonly known as a time spread or a calendar spread. But the diagonal spread, notice that you've got different expirations and different strikes. So maybe I buy the March 60 call down here and sell the Feb 70. But also notice there are two different ways I could spread off diagonally. I could also go in this direction. And there's a very good reason why I might want to do this. And in fact, most traders will use this diagonal spread over this one. But for right now, I just want you to see where the name diagonal spread is coming from. So for those of you who are using diagonal spreads, here are a couple of powerful tips for you. Tip number one, keep your cost below the difference in strikes. So let's go back to the example where you buy the 100-105 diagonal spread, and let's say that it's trading for $10. So you buy this one, you're hoping that that 105 expires worthless, and you're going to keep selling it, let's say week after week. But at some point, maybe even on your first attempt here, if the short call goes deep in the money, you might not wish to buy it back, or you might not have the cash to buy it back. And so you say, well, let me just take the assignment and then I'll exercise my long, but now you've locked yourself into a loss. And that's because your cost right here at $10 was larger than the difference in strikes. So to make the example clear here, you bought the 100-105 diagonal spread, and let's say that at expiration of the short call, the stock is maybe at 108. So that 105 call is in the money a little bit, and you say, I just don't want to spend money to close it out. Or again, maybe you don't have the cash. Now, as you'll find out, tip number two might bail you out of this one. But if it's only in the money a little bit, it might not. And so in this case, you might say, you know what, I'm just going to take the assignment on that short call. I'll receive 105 cash, but then I will have a short stock position. I have the obligation to sell shares at 105. How do you cover the short stock position? You exercise the $100 call. And where do you get the $100 cash from? From right here. Remember, you received that from the assignment on that short. So it's self-financing. If you take the assignment on this call, there's nothing you need to do other than to exercise that long. Now, notice that you've collected the $5 difference because you paid $100 and sold for 105, but you paid $10 for the position. So both positions cancel out, and guess what? You're left with a $10 loss. And that's because when you put the position on, you paid $10 for something that had a $5 difference in strikes. And so the best prevention is to not get into the potential situation in the first place. So when you're setting up your spread, set it up in a way that your total cost is going to be less than the difference in strikes. Okay, so what's tip number 2? Well, you could also consider rolling your long call. So let's say that the stock has really ramped up and that short call is super deep in the money. Maybe the stock is at $120. And you're saying, well, I definitely don't have the cash to buy this one back, so I have to just let it go. Not necessarily. If that short 105 call has $15 of intrinsic value at expiration, remember we're talking about right at expiration, so it's trading at $15 and no time value. Well, guess what? Your long call also picked up $15 of intrinsic value. It's a lower strike call. It absolutely had to. So what you could do is you could roll that long call to generate the cash to buy back the short. Now, of course, there's a lot of other considerations that might go into the equation here, but I at least wanted to pass on those 2 tips, because if you at least never entertain the idea of getting yourself locked into a loss, you'll never really have that problem. So it's really tip number 1 that you want to pay the most attention to. But for those times where that stock really goes super high and that call goes deep in the money, consider rolling that long call, and that's a nice way to still stay in the position and still collect that cash from those premium rich options. For anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.